Very happy Thursday to you. Welcome to our next edition of the Elville webinar series. I'm Jeff Stauffer, Community Relations Director with Elville and Associates, and I'll be your moderator for today. Our topic today is life and long-term care insurance in today's marketplace. And we have a very special guest presenter today, Mr. Max Reamer, advisor with the Quantum Group. Max was one of our outstanding presenters at our annual client event last November, and it's great to welcome him back and have him share his insights with us today. And you're in the right place for high-level legal and financial education today. We always encourage your general questions, so please note them in the chat or questions section on your screen, and we'll pause periodically throughout to address them. And your questions, they add a lot of value. They help others learn, so don't be shy in posing your questions at any time. This morning by email, you received today's presentation slides Max will be referencing. And these slides are also available in the section marked handouts on your screen to download at this time. And everyone will also receive a post-webinar feedback email right after the presentation. So please take just a couple minutes to fill out this very brief survey and offer us your feedback about the presentation. And we read and value every comment that you have to share with us. And here at Elville and Associates, we're always here as a resource for your family and you. New planning needs that you have to address, or outdated documents that may need to be reviewed, or perhaps another matter, Steve Elville and his team are always here to advise and counsel you every step of the way. And so I'd like to offer Max a proper introduction, and then we'll jump right into the presentation. So Max Reamer provides comprehensive insurance solutions for business owners, professionals, and families utilizing wealth creation, wealth preservation, and tax mitigation strategies. Prior to joining the Quantum Group, Max spent 5 years at Northwestern Mutual. Max holds a Maryland Life and Health Producer license. Max was born and raised in Baltimore and is a graduate of St. Mary's College of Maryland, where he played 4 years of varsity lacrosse. Max currently resides in downtown Baltimore with his wife, Katie. He is an active member in the community, where he is involved with the Cystic Fibrosis Foundation, Ullman Foundation, the Associated, and the Jewish Community Center. Max is also a board member of the Baltimore State Planning Council, where he heads the committee for their Emerging Planners Program, along with being a board member of the JCC. So Max, welcome. It's great to have you back and great to see you again, and looking forward to listening to what you have to share with us today. I'll turn it over to you.
Wonderful. Thanks so much, Jeff, and thank you for having me this morning, and thank you to all the participants that are joining us. With that being said, Jeff, laid down the bio, so I'll just go ahead and get right into the actual presentation. The purpose of this conversation is really just to give you a high-level perspective around life and long-term care insurance. So first, we're going to be discussing life insurance, and then at the later part, or within the later part of the presentation, we'll go ahead and discuss long-term care. So with that being said, really the first defense, if you will, as far as how to obtain the most effective life insurance policy, all comes back to underwriting. For those who don't know what underwriting is, essentially it is how the life insurance company determines what your premium cost is based upon your medical underwriting results. What I mean by that is after the underwriting process, they issue an underwriting rating, and the more favorable the underwriting rate is based upon your health, the more favorable your premiums are. And on the other end of the spectrum, the less favorable underwriting rating that you obtain, the more premium is going to cost. So there are two ways in which a client can engage in underwriting. The first is what is called formal underwriting. What that entails is the client submits a formal application and most likely will go through a medical exam. Once the application and exam results are processed by the life insurance company, they issue you a formal underwriting offer. The main difference between the formal and informal process is whatever results stem from the formal underwriting process goes into what's called the MIB, the Medical Information Bureau. Essentially what this is you could think of it as your permanent record for any insurance application results that you have obtained. Meaning, whenever you apply for insurance, whether it's life or long-term care insurance, that insurance carrier in which you're applying to can go back and look at your previous MIB results. So if they see, very favorable underwriting offers from your past formal underwriting results, there aren't going to be any issues. However, if they see unfavorable underwriting offers in the past or even declines in the past, that may affect their underwriting offer no matter what your exam results are. What I mean by that is, let's say 3 years prior to a formal application that you're applying to, you got dinged up in underwriting. Again, whether it was an unfavorable offer or a decline, but now your health has changed for the better, and it's now been 3 years since that unfavorable formal underwriting offer. You go through the formal underwriting process again, everything is great, but they see that there was a decline from 3 years ago. That may affect your new offer, because in their mind, we lose leverage essentially by getting you the best class offer, because they have seen that an insurance carrier 3 years ago gave you an unfavorable offer or a decline. So that is the main difference between formal underwriting and what we're going to discuss as far as informal underwriting. So in order to combat the unfavorable MIB results, we engage in informal underwriting. So what that entails is there are no exams, there are no formal applications. What we do is we just obtain a HIPAA form, which will allow us to essentially go ahead and order medical records in-house. And once we're able to process those records internally, we can go ahead and shop out on a confidential and informal basis which life insurance company is going to give us the best rate. And what I mean by that is, you can see we have 1, 2, 3, 4, 5, 6, 7, 8 different life insurance companies in this instance that we informally underwrote a client for. And just to take a step back, each insurance company have different risk tolerance. What I mean by that is, in this instance, this client had some heart issues. You can see that the informal offers ranged from a decline to a preferred non-smoker with John Hancock. So in this instance, John Hancock was a lot more liberal with the specific risks that the client had as far as an underwriting perspective with his heart issue, as opposed to Protective is much more conservative with any sort of cardiac history. So we were able to determine, without any sort of formal applications or medical exams, that Hancock was going to give us the best offer from the start. And what we did was we avoided any declines or even a high table rating, which we may have had we have just gone formal from the start. And if we did a formal underwriting process for this client from the start, he could have gotten a decline or a high table rating, which would have then potentially lost leverage by pivoting to another carrier like John Hancock. in which they might not have offered a preferred because they would have seen the unfavorable offers within the MIB from the initial formal underwriting process. So the main takeaway here is if you are dealing with an insurance professional, please make sure that they are asking some preliminary underwriting questions prior to any applications or taking a medical exam, because with that preliminary underwriting information, they can determine whether or not it makes sense to just formally apply somewhere off the bat, or go ahead and move forward with the informal underwriting process to combat not having an unfavorable MIB result. Once you determine which life insurance company is going to give us the best underwriting offer, the second line of defense, as far as ensuring that you are obtaining the most effective life insurance policy, would just be from a product standpoint. There are two main life insurance products out there. The first is term insurance, and the second is permanent insurance. The main difference is term insurance is you are essentially renting the coverage for a finite number of years. So term insurance spans from anywhere from 10 to 30 years of coverage. What that means is if you implement, let's just say, a 20-year term policy, you effectively are obtaining life insurance coverage for 20 years in which everything is contractually guaranteed for those 20 years, meaning they cannot revoke the coverage as long as the premiums are being paid, as well as they cannot increase the premium within that 20-year window. So you could essentially think of it as renting life insurance, where you have this insurance over your head for a finite amount of years, but once that term duration is done, then you don't have anything to show for it. It is a really great way to obtain the most amount of coverage for the most cost-effective price if there is only a specific number of years as far as the window of what you need coverage for. So let's just say that you are a young couple that just had, their first kid, and they want to make sure that they are covered for as much insurance as possible throughout the years in which, the kid, up until the kid graduates college. Well, a 20 or 30-year term would be perfect for that. However, a lot of people need permanent insurance for a couple of different scenarios. And what I mean by permanent insurance is it is coverage that you cannot outlive. So these policies are designed to pay out a death benefit no matter whether you live to age 60, 70, or even 100 plus. So in those instances, it would be for estate tax mitigation, or if a lot of times folks have special needs trusts that they need to fund, in which they want to ensure that they are leaving a benefit for their special needs loved one, whether or not they live to age 70 or 100 as far as the insured is concerned. So with permanent insurance, there are a lot of different types of policies under the umbrella of permanent insurance. That is whole life and universal life policies, in which there are different flavors of universal life policies, which are indexed universal, guaranteed universal, and variable universal. We're not going to really get into the nuances of the different types of permanent insurance policies, but really I want to make sure that the main takeaway is what is the difference between term insurance and permanent insurance. And really it's just term insurance is meant for a finite number of years as far as what that insurability period needs to be, versus permanent insurance is designed to pay out no matter how long the insured lives based upon certain goals and objectives. The one nuance that I want to talk to about term insurance is really all term insurance products are not created equally. What I mean by that is, one, you want to make sure that the insurance professional that you're dealing with is an independent broker. So they have access to all the products in the market. So when we go ahead and we quote out term insurance, you can see on this spreadsheet that there are, a plethora of products and carriers. We have Penn Mutual Protective, Symetra, Principal, American General, Transamerica, etc. And you can see the price differences. And one particular factor or nuance that one should pay attention to is what is called convertibility. What convertibility states is if you have a term insurance policy, you have the ability to convert it into a permanent insurance product without having to go through underwriting. An example of that would be if this 45-year-old gets a 10-year term insurance policy where you could see term 10, 10-year, etc., and they are rated at preferred non-smoker. And 5 years down the road, something happens, whether they're terminally ill, they just got a diagnosis, or they just wanted to make sure that they maintain this $1 million benefit on a permanent basis now because their goals and objectives have changed. If they have favorable conversion privileges, they actually have the ability to convert that $1 million at their given age. So in this example, they would be 5 years old or so at age 50, still at preferred non-smoker rates without having to go through underwriting. I went ahead and bolded this Penn Mutual Guaranteed Convertible Term 10 product because you can see that premium at $757 of annual premium is a little bit more expensive than the $669 premium. The reason of that $88 increase is because this Penn Mutual Guaranteed Convertible Term has much more favorable conversion privileges than those listed before that. So it is sort of you get what you pay for, where you don't necessarily want to just go into a term insurance policy that is the cheapest premium. What I mean by that is if you look at this next slide, you could essentially see the companies that have the most cost competitive term insurance policies on the market. And I am not a Penn Mutual rep. I don't put their products over any other unless it makes the most sense for the client. But you can see from a convertibility standpoint, at this current time within the marketplace, they actually have the most favorable conversion privileges. So you could see that it is convertible to any sort of their permanent product suite, and it is convertible within the full term period where you could see Equitable, Nationwide, New York Life. Their term products are not convertible throughout the whole 10-year, 15-year, 20-year term duration, etc. As well as you can see which type of products, one, you can convert to, and two, whether or not that product is actually a competitive price pointed product within the marketplace. So you can see from this chart, the competitive products are going to have the check marks. The non-competitive products are just going to be a zero, and then the zero with the line of it, and it shows that you cannot even convert to some of those permanent insurance products. So the main takeaway within these previous two slides is you want to ensure that when you're working with an insurance professional for term insurance, you're essentially getting what you're paid for, what you paid for, in which the term insurance premium is within the same ballpark as the most competitively priced term product. But you're also not going to anywhere that is going to be more expensive than what I just have in bold, where other companies are, and they're just not even shown within the spreadsheet because they're not competitive at all. So that is the main takeaway with term insurance. When we're looking at permanent insurance, as far as the product type here, you can see that I have index universal life policies, regular universal life policies, variable universal life policies, and whole life policies. As I indicated previously, I'm not going to go down the rabbit hole as far as the nuances of each, but I just want to pay attention to the benefit, the guarantees, and the premium price point. So I highlighted the two products. One is the Prudential product, highlighted in green, and the second is the Mass Mutual product, highlighted in red. You could see it is for the same $1 million benefit that are guaranteed through extended maturity ages, so post age 100 for both scenarios. But look at this premium. The premium for the variable universal life is $9,600, where the whole life policy is over $20,000. That is an amazingly different, that is a drastic difference in an annual premium. And when we think about permanent insurance, as far as we know that this is going to pay out because it is designed to do so no matter how long you live we want to ensure that really the internal rate of return on your premium is as favorable as possible, because that's really what determines whether or not this was an effective wealth transfer play to begin with. So if we can go ahead, again, that second line of defense to ensure that you have the most effective life insurance policy for your needs is from a premium standpoint. If I'm having my client pay $9,600 on an annual basis, as opposed to $20,000 on an annual basis, that premium mitigation with the $9,600 is going to obviously increase the internal rate of return once that benefit is paid. And that is everything as far as making sure that you're having an effective life insurance policy for your goals and objectives, which is making sure that you have a benefit when you pass away, and you want to be doing so within the most cost-effective basis. So those slides and talking points is based upon how to navigate the life insurance market when you are obtaining a new policy. We come across scenarios in which the clients already have life insurance policies and they've had them for 20 plus years. So it's our job to evaluate those policies to determine, hey, this client has obtained this policy 20 years ago when their goals and objectives were XYZ. Now the clients are 20 years older and their goals are ZYX. Is this still the best possible policy for these new goals and objectives, which have changed since the inception of the policy? Sometimes it's perfect and it makes sense for the policy to stay, to have the client stay within the policy as far as where they are already, or there are strategies in which we can go ahead and obtain a new policy that fits their goals and objectives much more effectively. So in this scenario, we evaluated a life insurance policy in which the clients were paying $5,100 of premium. They had a $1 million policy guaranteed to their ages 100 plus, let's just say, and they had some cash value built up into the policy in which we could potentially leverage into a new policy. And we wanted to determine if we leveraged the $77,000 in this scenario, which they have already built up in their current Pacific Life policy, would that offset the $5,100 annual premium cost? We did a marketplace analysis, and what we found is if you look at the guaranteed death benefit duration column, the products to have similar guarantees within, again, ages 100 plus, leveraging the $77,000 of quote unquote cash value that they can implement in a new policy, their annual premium is looking much more than the $5,100 that they've already are paying. So for instance, the Securian was the most attractive options to maintain the $1 million guaranteed to ages 100 plus with the $77,000 cash value being leveraged from their old policy. The annual premium was over $14,000. It would make no sense whatsoever for the client to replace their current Pacific Life policy, which is highlighted in green. So that's just an exercise that clients like running because it just gives them a peace of mind saying, hey, I know that when I pay that $5,100 premium within the given years of the policy, I am absolutely in the best scenario. The second example in which I'm highlighting is the Lincoln policy that is highlighted in red. What this scenario was, this client had a $200,000 life insurance policy in which it was paid up, meaning he no longer had to pay any premium on an annual basis. He did, however, have a decent amount of cash value built up in the contract, roughly $150,000, which I'm circling here. We wanted to determine, could he potentially leverage that $150,000 of cash that he has already accumulated in his current policy into a new policy with still a $0 ongoing premium. And what we found was Prudential actually gave us not only roughly $34,000 more of death benefit, it actually upped the guarantees within the policy from his age 78 to 100. Again, while still maintaining that $0 premium outlay. So in this scenario, we actually exhausted the market and found a product or a new policy in which not only were we able to keep his premiums eliminated, we got him $34,000 more benefit while also upping his guarantees to age 78 to age 100. So there's a scenario that was a no-brainer as far as, yeah, your goals and objectives based upon the current goals and objectives, there actually is a new policy that is much better suited for your needs at this time. I'm going to go ahead and stop here before I get into long-term care, and wanted to see if you guys have any questions about life insurance in general, whether it is pertaining to any topics that we've recently discussed or something that we haven't yet.
Hey, thank you, Max. One of the questions that I did send your way, actually, it refers to long-term care insurance. I don't know if you want to wait for that. The question posed was, by what age would you recommend we attain a long-term care insurance plan? I don't know if you want to dive into that right now or maybe wait
Yeah, I think that's a great question, sort of to act as a segue into long-term care. So there's really not a magic age in which one should purchase a long-term care policy, but a rule of thumb, we're looking anywhere from age 50 to 65. And the reason being is because before age 50, long-term care isn't really a true risk. One would argue that long-term disability insurance is actually a more important risk management policy at that given age than long-term care. And then the reason why we sort of cap it off at age 65 as our rule of thumb is because the average long-term care age is 80. So once we are getting within that 15-year window of the average long-term care age, carriers tend to increase the premium. Now that, again, it really does depend on the specifics as far as, you know, how healthy the client is, meaning healthy 68-year-old would be would have a much more favorable premium than a not so healthy 52-year-old. So there are a lot of factors as far as what is a more effective age to purchase long-term care, but again, just a rule of thumb, anywhere from age 50 to 65.
Okay, great. Yeah, I'm sorry, go ahead.
So I would say, are there products that are better served with for folks with special needs trust? For long-term care, it's almost a moot point because you know, really when we are funding special needs trust, it's for a tax-free life insurance need. So long-term care isn't really suited for special needs trust, but as far as life insurance, those products would be permanent insurance products that have guarantees, meaning if we revert back to this market analysis, if you will, you could see that the guaranteed death benefit duration rate, or let's go ahead and look at this this graph. You could see these different life insurance products, index universal life, variable universal life, etc., and just traditional universal life. They have different death benefit guarantees durations. When we are implementing insurance for a special needs trust, we want to ensure that we're having very favorable death benefit guarantees, aka ages 90 plus, because we want to ensure that that special needs loved one is going to receive the benefit within the trust no matter how long the insured lives. And what I mean by that is if we implement something with less favorable guarantees, such as age 78, and the insured has been paying the premiums for 20 plus years, and the policy does not perform favorably, and the policy lapses at their age 80, that's a big problem. That means that they're going to have to go ahead and implement a brand new policy, and at that point, they may or may not even be insurable. So we want to ensure that the products in which is needed for a special needs trust have favorable guarantees. Any other questions about life insurance before I get into the different long-term care products?
Max, it looks like we have another one here. Let me see, just came across. It says I have life insurance through my employer. Would reassessing my life insurance policy be recommended when I retire?
That's a great question. It depends on the actual policy in which your employer offers. What I mean by that is you can ask your HR whether or not the product or the policy from the benefit is what's called portable. So sometimes life insurance through your company may not have portability privileges, and what that states is you are, insured when you're with your employer and you're still working with that particular employer, but once you retire, they may say that you have no access to that policy. However, if you have what's called portability privileges, you can go ahead when you retire and you could actually take that existing policy that you have been with throughout your employment and move it into something that is personally owned, meaning like, hey, I'm going to retire and I want to go ahead and make sure that this policy is portable to carry it after I'm with, after my employment, post-employment. So that's what you need to ask your HR department, is whether or not the life insurance policy that you currently have through your employer is portable. If so, great. If not, then yes, you would want to go ahead and look at what your options are as far as the individual life insurance market to ensure that if you still want insurance in retirement or after, after you move on to maybe even a different employer that may not offer as robust life insurance benefits, that you'll still have a policy in place.
Okay, Max, I'm going to send you one more, a little bit longer, so it might be best if you read it.
Okay. It's a great question. So this individual is asking about grace periods or elimination periods as far as, got it, once you qualify for a long-term care event, which is based upon the activities of daily living. So let's take a step back. And again, another perfect question, just to segue into long-term care products. What entails a long-term care event? Meaning, what makes you qualify for a long-term care event? That is if you are not able to perform 2 of the 6 ADLs, which are activities of daily living. Those are, let me just make sure that I don't butcher this. Give me 2 seconds. So the 6 ADLs are eating, bathing, dressing, transferring, so just moving in and out of bed, etc., toileting, and just walking around and movement. If you cannot perform 2 of those 6 ADLs, you qualify for a long-term care event. So whether you have a stroke, you're diagnosed with Alzheimer's, cancer, you took a terrible fall, etc., if your doctor writes a note to the insurance company saying, hey, my patient I vetted my patient and they cannot perform 2 of the 6 ADLs, your claims process is now started. With the claims process, depending on how you design the long-term care policy, you have what's called an elimination period or a grace period, in which, let's say it's a 90-day elimination period. That means that day 1, you have been approved for the long-term care event. You will not get the benefit up until that grace or elimination period has been satisfied. So in this example, if the elimination period is 90 days, you will not get that monthly long-term care benefit until day 91. Now, there are ways to slice and dice long-term care policies in which you can lower or increase the elimination period, meaning you can have a 0-day elimination period, but that means that your premium is going to skyrocket. You could have a 180-day elimination period as opposed to 90 days. That means that your premium will actually be mitigated because you are delaying the time in which the insurance company has to pay you day 1. I would say the sweet spot is the 90-day elimination period, because when we're looking at long-term care, the name says it all. We are trying to ensure a long-term care event. So it may sting a little bit to go out of pocket for 90 days, 3 months, but from a conceptual standpoint, that really is a short-term period. So if we want to design this policy as cost-effective as possible as far as the premiums are concerned, 90-day elimination period makes really the most sense, because it's making sure that the premium is most cost-effective, and we are insuring against that long-term period, which is anywhere from 3 months plus. So hopefully that answers as far as the activities of daily living and the elimination or grace period. Any other questions before I get into the long-term care slides?
Max, I think you've covered everything. Thank you so much.
Wonderful. So there are two main products when we talk about long-term care. The first is just traditional long-term care protection. And just to give you some background as far as the long-term care market, this is not the oldest insurance product that we've seen in the marketplace. But it's old enough in which when it was originally introduced to the market, the technology that we have now from the healthcare side of things, they weren't even in existence. So when long-term care was first introduced to the marketplace, it was really a race to the bottom as far as who can be the most cost competitive, because all these companies that just introduced this new product wanted to get all the business. So they were priced very, very competitively without realizing that over the course of time, folks were just going to be living a lot more longer with technology, etc. So what I mean by that is nowadays, a lot of these companies that were once in the traditional long-term care space are completely out, because they cannot keep up with the claims that they have on their books already in existence. So really the only carrier that still even entertains folks for traditional long-term care is Mutual of Omaha. And that's why you can see on the next slide, which we'll get into as far as hybrid policies, we have Nationwide, Securian, and Lincoln. You'll only see Mutual of Omaha when we exhaust the marketplace, because they're the only true traditional long-term carrier that is still conducting business within this space. So what I'm going to do is just go over these columns, and my hope is once we are through going over column to column, you'll be able to digest how these policies actually work. So first we have a Comdex score. That's just stating how financially stable the company is. We don't work with carriers that are at least A or above rated. You have the insurer's gender, male. You have the annual premium of $4,000, and that roughly, and that premium duration is to age 100. So it's pretty much for the duration of the policy. And what this annual premium gets us, I'm going to be jumping around for a little bit, is an initial monthly benefit of $7,500. The average cost of long-term care in Maryland per month is anywhere from $7,500 to $8,000 a month, which is why we're starting with that initial monthly long-term care benefit of $7,500. However, we have to recognize that this client is only 44 years old. So the likelihood of him needing long-term care now, as opposed to later down the road, is slim to none. So we have to make sure that this long-term care benefit is still keeping up with the future costs of what he may need for long-term care purposes. So how we ensure that is we put in inflation rider. You can see this 3% inflation rider. What that states is that initial monthly long-term care benefit of $7,500 is going to increase by 3% on a compounding basis year after year. So if you go ahead and just follow me to these given ages that are latter ages in the policy, at his age 80, that monthly benefit is now roughly $22,000 a month. So that $7,500 of initial monthly long-term care benefit day one of the policy has now grown at his age 80 to roughly $22,000. How the long-term care payout works is you're essentially buying a pool of money. So you could see from this initial design, this is a 4-year long-term care duration. What that means is if you go ahead and you times 21,000, which is the initial monthly benefit, times 12, which there are 12 months in a year, times 4, the long-term care duration, you roughly are going to get $1 million of long-term care pool that this client has the ability to access on a monthly basis tax-free. And how this long-term care pool works is it's essentially rollover dollars, meaning if you went ahead, you have a maximum monthly amount at his age 80 of $21,783. If you took the maximum monthly amount every single month, your long-term care pool will last you 4 years. However, if you went ahead and let's just say your long-term care event, you needed half of that per month, you didn't need to exhaust it as far as the maximum monthly amount allowed you to exhaust. If you just needed half of that, your pool of money would last 8 years as opposed to 4. So that is how the long-term care pool works. The only other thing to take note within these columns is one, to the point that I just discussed based upon the question of a grace or elimination period. You can see that we designed this policy for that 90-day elimination period. Again, we could have designed it for a 0-day elimination period, but that would have skyrocketed the annual premium to, let's say, $4,000 to $7,200. Vice versa, we could go ahead and design it for that 180-day elimination period, which would have mitigated the premium, let's say, to $3,200 a year. But going out of pocket for 6 months as opposed to 3, that may be very detrimental to the client's financial situation. The only other thing worth noting is the benefit type. These traditional long-term care policies nowadays are reimbursement, meaning the client goes out of pocket day one, or excuse me, at the first of the month, and they'll just go ahead and itemize their expenses, and then the carrier, the life insurance company, will give them a tax-free reimbursement at the end of each month. There are 2 other extremely important points that are not listed on the spreadsheet within the traditional long-term care space. First is that these premiums are not guaranteed. To revert back to what I was saying as far as at first when these carriers priced long-term care policies, they priced them way too they priced them way too low to begin with. So now these companies, they don't even want them on their books, including Mutual of Omaha. So these premiums for traditional long-term care are not guaranteed, meaning you very well may get a premium notice in your mail 1, 2, 5, 10, or 15 years down the road saying, hey, these premiums weren't guaranteed to begin with, so we're actually going to increase your premium to maintain the same monthly long-term care benefit by 30%. Or you could maintain the same premium, but you have to lower your benefit by 30%. That's not a great notice to receive. So that's a huge pain point within the traditional long-term care space, because their goal as a carrier is they want to get this risk off their books. So they want to jack up the premium price, knowing that they don't want to end up paying a claim because, again, they just priced it to begin with incorrectly. The other thing that is worth noting is what happens if you paid into this policy. In this scenario, the client was 44, and let's say he passes away at 84 without needing a long-term care event. So he would have paid 40 years of premium that most likely would not have remained at $4,000. So that would have been an extreme cumulative premium cost. But if he didn't use any of the long-term care, there's nothing that he would obtain to show for the cumulative premium that he's already paid into this policy. So you could sort of think about traditional long-term care in a sense as car insurance, right? Where yes, it's really great to have protection, God forbid something happens, and it's a nice peace of mind knowing that you have protection in place. But at the end of the day, you're going to have nothing to show for your cumulative premium if you don't need long-term care, which hopefully, which actually is the most favorable situation because you lived either a long or healthy life, or you just passed away in your sleep. So those two main pain points, the premium not being guaranteed for traditional long-term care, and it's sort of like if you don't use it, you'll lose it as far as your cumulative premium is concerned, made the long-term care industry, it sort of flipped it on its head because not a lot of people are now finding traditional long-term care attractive. So in order to combat that, what long-term care insurance company has done is come up with another product called hybrid long-term care, which is this slide, which we'll get into. But before I do, I would like to take a break and to see if anybody has any other questions about traditional long-term care.
Max, thank you. I just forwarded you another relatively longer question.
Say that again, Jeff.
I just forwarded you another relatively longer question, again, regarding the grace/elimination period in your chat there.
Okay.
Do you see that question, Max?
I do not. Oh, here we go. Yeah, it just came up. Give me 2 seconds to read.
Okay.
That's a fantastic question. So the question that was asked is what happens as far as the elimination period if there are multiple long-term care events per one insured. So if it is the same long-term care diagnosis over the course of 2 different events, then as long as that elimination period was met for the first long-term care event, then the second time they have to go on long-term care for that same illness or diagnosis, that benefit will go to them day one because the elimination period was already satisfied. Meaning, let's say that somebody was diagnosed with cancer, they have a long-term care event, they qualify for long-term care, they satisfy the elimination period of 90 days, they receive 2 years of long-term care benefit, then they recover, they're in remission, and 5 years down the road, the cancer comes back. If it's the same cancer, then they don't have to go through an elimination period again because, again, that was already satisfied within the first claim. However, let's say that they're in remission and God forbid, now they're diagnosed with Alzheimer's. So they qualify for a long-term care event, but it didn't pertain to the previous long-term care event. You will then have to start the elimination period again. Yes, I can. The question was, can you go ahead and do the math on the pools? So let me just preface this by it's not going to be dollar for dollar when I'm doing these calculations in a second, because you have to go ahead and equate the inflation period, the inflation rider every single year. But for instance, at age 80, the monthly long-term care maximum amount is $21,783. So what I'm doing is $21,783 times 12 is going to give us an annual long-term care pool of roughly $261,000. If I were to multiply that annual pool of 4 times that by 4, that's where I'm getting roughly that $1 million of total long-term care pool. So again, it may not be dollar for dollar because every single year, technically, the pool is going to be increased by that 3% inflation rider, but just, for napkin math instances, that's how we calculate the pool. Our long-term review, yes, it is. So one of the questions, there's 2 additional questions. One of them asked, are the long-term care increases reviewed by any government agencies? Absolutely. So really, they are the gatekeepers to determine, one, if it's kosher for these long-term care companies to increase their premiums, and if so, by how much. So for instance, let's say the client is in Maryland, they have a long-term care, traditional long-term care policy with Mutual of Omaha, or like Genworth. Genworth wants to increase their book of business increase their premium on their book of business for traditional long-term care products. They have to go to each specific state insurance commissioner. So in this example, the Maryland insurance commissioner, and say, hey, based upon our claims history, this is why we want to increase the premium by 30%. It is up to the government agencies to grant that increase. 99% out of 100, they will go ahead and grant it. But it is based upon the government agencies giving them permission. Second question. So this participant asked whether or not so I'll just read it verbatim. My employer has been advertising a hybrid life/long-term care insurance product as an option in our benefits. Is this a common thing? Are these recommended? I honestly, it's very rare that I've had a client in which their employer has offered a hybrid long-term care product. Typically, it is sort of carved out for the C-suite executive. So I don't know if you are a C-suite executive or not. So it really isn't that common. And like I said, on the off chance that it is offered based upon an employee benefit, it's typically carved out for the C-suite executive. And I would say, go ahead and compare what they're offering to just, the current marketplace products and determine whether or not, what's the most attractive option. But if you are within that age range of 50 to 65, I would absolutely recommend checking out, the hybrid products, whether it is via your employer or just a, traditional long-term care carrier. Jeff, before I get into the hybrid policies, wanted to see if there are any other questions we're waiting on.
Thanks, Max. No further questions.
Great. So just to take it back to where we were, the two main pain points of traditional long-term care is if you don't use it, you lose it, and the increase of premiums, being that the premiums aren't guaranteed. So in order to combat that, what the long-term care industry has done is create what's called a hybrid long-term care policy. What you can see here are, again, some columns that we've already gone over and some additional columns. So as I alluded to a little earlier, we can go ahead and exhaust the marketplace for the top companies that offer long-term care on a hybrid chassis. And the three most competitive companies that are offering hybrid long-term care policies are Nationwide, Securian, and Lincoln. How these hybrid policies work is, again, you have your Comdex score, which just shows the financial stability of the company. And just as a disclaimer, these quotes were from, I want to say, last year. So these price points have changed. As of recent, actually, Lincoln is going to be more competitive than Nationwide and Securian. But just for the sake of education, I'll just run through the columns, and it sort of is a moot point as far as where the companies stand now from a competitive standpoint. But you can see that you have an annual premium, and that annual premium is going to be a higher out-of-pocket cost than the traditional life insurance policy, because typically these hybrid contracts are designed to either be a single premium or to be paid up in a 10-year premium pay schedule. So you can see the premium duration is a 10 pay, meaning this thing is paid up in 10 years, as opposed for the traditional life insurance, that was for the course of the whole entire policy. So even though it is a higher out-of-pocket cost at first, depending on how long the client lives from a cumulative standpoint, the traditional policy very well be much more expensive, knowing that this policy is paid up in year 10. So call it $120,000 from a cumulative premium standpoint that the client pays. However, if the client has to pay, to his age 90, $4,000 a year, that's a $360,000 cumulative premium spend point. So just to keep note, again, you can see that we're solving for the minimum premium needed to have an initial monthly long-term care benefit of $7,500. It's the same inflation rider. So you can see these numbers on these given ages are very similar to what we went over. You have your elimination periods. You can see that Lincoln actually has a 0-day elimination period, meaning the insured has got to get the policy day one, the benefit day one. And then what is different is you have a death benefit. So what this means is if the client does not use any long-term care, their beneficiary is going to obtain a death benefit of $180,000 tax-free. So think of it sort of as a return of premium feature where the client put in $120,000 from a cumulative premium perspective. If they don't use it for long-term care, their beneficiary is going to receive $180,000 sort of, hey, you didn't use it, but you still didn't lose it as far as your premium going down the drain. There's also a residual death benefit feature of these hybrid policies. What that is showing us is even if you do use it for long-term care, your beneficiary will receive a residual death benefit. It's a small amount, but it's a nice cherry on top, and really the purpose of this is for burial costs. There's also what is called a return of premium feature, meaning your premiums are actually being vested into the policy, where you, like, let's say that you don't want to go ahead and wait to obtain your premium back when you're 6 feet under and your beneficiary is going to be the one that sees the actual return of premium via the death benefit. If you want to wipe your hands clean, whether you really need access to cash or you're age 85, you're super healthy, and you don't even think that you're going to need long-term care, you have the ability to go ahead and sort of cash out this policy in which you'll obtain your return of premium while you're still alive, as opposed to wait until you pass away and your return of premium is in form of a death benefit to your beneficiary. Something that is also extremely different is the benefit type. Nationwide and Securian have what's called indemnity benefit types, where it is the opposite of reimbursement, meaning you will get your monthly benefit day one of the month, and it's yours to do whatever the heck you want with it, as opposed to going out of pocket day one of each month, having to itemize and then get a reimbursement on the back end. So really what we're doing here, if you think of it from a conceptual standpoint, is let's say your net worth or estate is worth a couple of $1 million, right? You worked so hard to save up for this retirement nest egg and to live off of your now net worth of $4 million, $2 million, whatever it may be. The biggest risk to your net worth and or estate is a long-term care event. So what we're doing is, for these hybrid policies, we're going to take $120,000 in this scenario of your $3 million net worth, park it into this hybrid policy, knowing if you have a long-term care event, your entire net worth and estate is protected with the long-term care benefit of, again, in this case, in age 80, $1 million. However, if you don't need it for long-term care, your cumulative premium will revert back into your estate/net worth, either in form of a death benefit or that return of premium feature. So that is how we position hybrid long-term care policies within a financial and or estate plan. So that will wrap up the sort of life insurance and long-term care 101 conversation. I know it was a ton to digest, so let me go ahead and field any questions. Got it. So this person wanted to revert back to the pool of money as far as the math. Sure. So what we're doing is we're taking this maximum monthly long-term care number here. We're timesing it by 12 because, again, these figures are just the monthly amount. From there, we are multiplying it by whatever the long-term care duration is, whether it's 4 years, 6 years, etc. And that is going to give us our total amount of long-term care pool within the policy. So just to go over the numbers again, at this individual's age 80, we have $21,783 a month of long-term care, in which we're going to multiply by 12 months, which gives us $261,396, and we are going to times that by the long-term care duration, which is 4 years, and that's what gives us the $1 million number, roughly $1 million number here. Hopefully that shed a little bit more light on the math. Jeff, any other questions?
Thanks, Max. I did pass a few others along your way there while you were answering that math question. Looks like the first one is, can traditional long-term care be converted to a hybrid long-term care?
Okay, got it. Oh, got it. All right. So there's a couple more questions coming in. No, it cannot. The reason being is because one, there's no cash value that builds up into the traditional long-term care, and from an underwriting perspective, the traditional long-term care policies do not have any sort of conversion privileges. So convertibility is strictly for term insurance into a permanent insurance product. Yes, thank you for asking. This question was, are hybrid policy premiums guaranteed? Absolutely, and thank you for asking because I forgot to confirm. Every single thing within the contract, AKA policy, from a premium and benefit standpoint are guaranteed. So you will never see any sort of increases, whether it's year 21 when the policy has already been paid up for 11 years that they're going to have to put more premium into this thing, or in year 8 when they're still in their premium payments that they're going to have to increase for the 2-year left premium duration. So everything is contractually guaranteed. So great question. How young can you purchase long-term care insurance? It depends on the carrier. Some carriers say, hey, I'm not going to go ahead and insure somebody at age 30, but relatively speaking, 40 plus, age 40 plus, you could be as young as 40 and get long-term care.
I think that last question, the addendum to that was considering that was for the person's special needs child.
Yeah, great point. That is going to be on a case-by-case basis because, again, depending on the underwriting, they may or may not qualify for this type of product. So, we can have a conversation offline, or if you already are working with an insurance specialist, you can just have a conversation with them saying, hey, I would like to purchase life and or long-term care insurance for my special needs child. Depending on the diagnosis and or severity of the special needs situation, they may or may not qualify for the coverage based upon underwriting. And that is a perfect conversation to have as far as whether or not you go with formal or informal from an underwriting perspective. What happens to the long-term care premium when you go on benefit? Great question. There's 2 ways that you can construct the policy. One is what's called a waiver of premium, meaning it's a rider that has an additional cost for the policy, but it states that if you go on long-term care claim, and then you do not have to pay any sort of premiums. But for these hybrid policies, typically when the client goes on claim, the policy has been paid off for a couple of years. So when they're on claim, they don't even have any premiums that are due, so it's a moot point. However, for like a traditional long-term care policy in which the premium durations are up until age 100, or for the duration of the policy, if you have waiver of premium as far as a rider, they waive the premiums when you're on claim, or you do have to pay your premium to keep the policy in force to still get the benefit. But it's just simple math, right? If the annual premium is $4,000 and you're getting a $21,000 of monthly benefit, then we'll just say like, yeah, a percentage of your monthly benefit is still going to go towards the premium to keep the policy in force so you could still maintain the benefit, but it's still a great policy to have. Yeah, age 70 for male non-smoker, no chronic illnesses, etc. To get a long-term care policy, absolutely, you should be able to qualify based upon what you just stated in your question. But again, that's just all stems from the pre-underwriting conversations with either myself or your insurance professional, where you say, hey, before I go ahead and apply for the quote they just gave me, let's have a conversation as far as what my potential health issues or concerns are that may or may not show up in underwriting, so we can determine, yeah, we're gonna see no red flags here, let's just apply formally right off the bat, or yeah, there could potentially be some red flags, so let's go ahead with a informal underwriting process so we could really firm up quotes before we move forward with a formal underwriting application and or exam, where if we get dinged up, then that is now going to be in the Medical Information Bureau. Can you explain to me the long-term care return of premium types? Absolutely. So you could see that these different products have different return of premiums, cash value, 100% year 11, 7% year 1, etc. They are just different types of return of premium based upon the company and product in which how your premiums are vested. Meaning for Lincoln, year 1, you'll get, if you wanted to wipe your hands clean as far as the return of premium feature, if you want to exercise that, you'll get 70% of what you've already put in. For example, in year 9, that could be 86% or 87%. At that point, once we are at the once we're far along in the process, we honed in on the premium and benefit amount that we want to move forward with. We will go over every single given year as far as how that premium has been vested within the number of years. So you could have an idea as far as, hey, what is my return of premium feature if I want to exercise it in year 9 versus 19, etc. I will say some products are more favorable with the return of premium, meaning Nationwide is going to be the most favorable, where you get 100% of your premium, so it's 100% vested after your premium payments are completely paid off, as opposed to Securian has cash value, which essentially is just your return of premium amounts are being invested based upon their sort of portfolio as Securian in a whole. Again, we're kind of going down a rabbit hole, but long story short, there are different ways in which the return of premium is grown within the policy. And just to give you an example of that, you could see the 2 Nationwide options here, where you have cash value return of premium and 100% return of premium. That's what's going to give you that $600 a year increase, because this 100% year 11 is going to be more favorable from a return of premium standpoint than the cash value. This next question is age 64, non-smoker with 1. So this question is, at age 64 for a white female with 1 chronic illness that is under control and in good health, can they get a long-term care policy? Again, most likely yes, but it all stems from that initial informal conversation as far as what is that chronic illness and how under control is it? Because at that point, it's, all right, let's determine what the chronic illness is, and then we'll have an informal conversation. 1, if we can qualify, and if so, which insurance company is going to look at that chronic illness in a much more liberal light. Meaning, let's say the chronic illness is based upon thyroid, a thyroid problem, what have you. Securian is actually much more favorable with thyroid situations than Nationwide or Lincoln. So you may not be able to obtain policies with Lincoln or Nationwide, but Securian may very well offer you coverage. So again, it all stems from that informal underwriting conversation. But most likely, yes, 1 chronic illness that is under control, everything that's in good health should be completely fine. Next question, can you elaborate on slicing and dicing the ADLs? So you're not slicing and dicing the ADLs. The activities of daily living just dictates as far as if you qualify for that long-term care event, which is 2 of the 6 activities of daily living, which again are bathing, eating, continence, transferring, so on and so forth. if you cannot perform 2 of the 6 ADLs, no matter what the diagnosis or illness is, you qualify for a long-term care event, whether it's cancer, Alzheimer's, even diabetes. If your diabetes is so out of control that you cannot perform 2 of the 6 ADLs, as long as your doctor verifies and vets that you cannot perform 2 of the 6 ADLs, we're good to go going forward with the claim. Great question. Do hybrid long-term care do hybrid long-term care / life insurance policies have the same life insurance underwriting as whole life or permanent insurance policies? No, which is awesome. So something that is very favorable about long-term care is the underwriting process is a little bit more benign than just traditional permanent and or whole life policies, where typically for permanent life insurance policies, including whole life policies, you have to get examined. For hybrid long-term care policies with these quote unquote life insurance death benefit riders, it's an application, and then it is a medical history interview that is conducted over the phone, which is in lieu of a medical exam. So what the underwriting process looks like for these hybrid long-term care policies is we submit a formal application. Once that application has been processed, the long-term care company gives you a call. It takes about 40 to 50 minutes, and they conduct a medical history interview as well as a cognitive verbal exam, if you will, like, hey, who's the president, recall, etc. From there, one of 2 things will happen. One, they'll offer the policy right on the spot, or they may have to order medical records. But the take home is you will not have to get examined, as opposed to traditional permanent life insurance policies, including whole life. You most likely will have to get an exam.
Okay. Well, Max, thank you so very much. That is Max Reamer, everybody. And what a wonderful presentation. Great information. Thank you all so much for the great questions. I think anything I say afterwards will pale in comparison to what Max just shared with us. So I'm going to keep it really, really brief. Max has served a lot of our clients here at the firm. And if you have specific questions, please reach out to him. As you can see, he is extremely knowledgeable. His service we've come to know is unparalleled, along with his analysis. So reach out to Max with your specific questions about your situation. Max, thanks a lot. Really great.
Yeah.
We've never really done something like this at the webinar series, and hope we can do it again. It would be great. I'll share Max's information in my follow-up message as far as his contact information. And along with our webinar series that's coming up, I'll send that as well, along with our video. And hope you all have a great rest of the week and a really nice extended Memorial Day weekend. And we'll see you again soon on the Elville webinar series. Max, thanks again.
Everybody.
We'll see you again soon.